Broadcom is very expensive. This stock is trading for a PE ratio of 92. It's not that much better if we look at the price to free cash flow, as the company is currently trading at a free cash flow multiple of 83. There's no two ways about it. This company is just extremely expensive. If we filter the S&P 500 and we look at the largest companies, those that have a market cap of $10 billion and above, and the companies that also pay a dividend, Broadcom is in the top tier of the most expensive companies in the market. It currently sits at number 13, but keep in mind that a lot of the companies mentioned above it are REITs. And REITs always have PE ratios that are out of whack. So if we take out those REITs, Broadcom is actually the number 2 or number 3 most expensive company in the S&P 500 today. So naturally, the question that a lot of value investors are asking right now is it time to sell? The stock is at an all-time high right now, which means that if you bought Broadcom at any point in history, you're up on your investment. My personal history with Broadcom is an interesting one. I first invested in the company in 2020, right after the pandemic. And so you could say I've done really well for myself. After this incredible rise in the stock price, Broadcom is now around 4% of my entire portfolio. And I'll be honest with you, when I first made this investment, it wasn't out of a particular vision that I had or talent. I would say it was pure luck. Back in those days, I was just starting with my personal investment career, and Broadcom had a very high dividend, which was in the mid 4% range. I was looking at stocks that had good revenue growth, good free cash flow growth, that had a good dividend, and Broadcom almost seemed like too good to be true. But that's about as far as my analysis went back then. Now, this spectacular rise has caused me to almost sell the stock twice. The first one was at the end of 2021, and for a year, I was very sad and very disappointed that I didn't sell. But then things bounced back almost very, very quickly, and towards the end of 2023, I was asking myself again whether this stock was overvalued. I chose not to sell, and the rest is history. Since Broadcom came out as an AI play, because we'll get into that in a second, but Broadcom is a major player in the AI race and the development of all the AI infrastructure, the market has put a heavy premium on Broadcom shares. And so optically, it has looked overvalued since 2021. But now, since the Trump tariffs, when the stock crashed 40% in a matter of a few days, it rallied back really, really strongly. And now it's once again at an all-time high. And it's time for me again to question whether now is a time to sell. Before we move on any further, I just want to do a quick detour and explain why having such a high PE or price to free cash flow, why having a high multiple on the stock is actually bad for your future returns, and why a lot of investors, whether that be value investors or other kinds of investors, try to stay away from stocks that have a really absurdly high free cash flow multiple. Let's say that we purchase a stock for $100. The point of investing is to put money in and get money in return. So all things being equal, we want the most money possible to return to us after we make the investment. That's completely logical. Let's assume that this stock is bringing us $100 in free cash flow per year. All things being equal, it means that the first year that we hold the stock, we pay back our investment, and the second year, we double our money. It's as simple as that. The reason why that's favorable as an investment is because that company could go out of business in 2 years and you would still have made a 100% return on your money. That's pretty incredible. Let's go down to the other extreme, where now the stock that you bought for $100 brings you in $1 per year. Well, once again, all things being equal, if this dollar keeps recurring every single year, it would take you 100 years to pay that initial investment off. So why would anyone in their right mind ever pay $100 for a stock that's going to bring in $1 in cash flow per year? The reason why an investor would be willing to accept a $1 return on a $100 investment is if they expect this $1 to turn into 2 the second year, into 5 the third year, into 10 the fourth year, 50 the fifth year, and so on. And that way, their investment would be paid in a lot shorter of a time than 100 years, and the return after that would be really, really good. And that's it. It's really as simple as that. The reason why paying a very high free cash flow multiple on any stock is risky is because this now becomes your expectation. And if the company does not deliver, aka if this incredible growth in free cash flow does not materialize, then you could be in really big trouble. The stock price could really plummet. And vice versa for the other side. If you're paying a very low price to free cash flow, in this case, it would be 1 times, then the risk is really reduced. As long as the company can stay in business for 1 or 2 years, you're golden. So that's it. That's all I wanted to say regarding this. So that's kind of where I'm at today. The question being, is it time to sell Broadcom and de-risk the portfolio in a way by replacing this stock with another one? And selling is always a touchy subject for any investor because it's a lot harder to sell than it is to buy. Buying is a lot more simple in many ways. It comes down to a few things. The first is, do you have spare cash? The second is, can you find a high quality company? And is that high quality company selling for a fair price? And that's really it. You can try to define quality any way you want. You can try to describe fair price any way you want. But once you have those definitions for yourself, then it's easy to know whether something is a buy. For me, in a way, that was the entire point of building the Rated A database. Identify the high quality companies, and we define high quality as companies having a strong moat, very strong profitability and growth over time, and being safe, basically having a low intrinsic risk. Broadcom is a very high quality company, but because of that free cash flow multiple, the value rating is actually a 0, a strong sell. But selling isn't as easy or straightforward as buying. First of all, you've got the psychological element to it. You get attached to a stock, it's done well for you in the past. Or if it's done poorly, maybe you want to recoup those gains before locking them in. So already that does something in your head and it makes it a lot harder to press on that sell button. But if we look at the actual scientific, in a way, reasons to sell, it comes down to 3 things. The first is that your thesis changes. What do I mean by that? When you buy a company, you're buying it because you think it's a high quality company for X reasons. Well, if those reasons change and the quality of the company drops, then the investment is not the same anymore. And so it makes sense to reevaluate and see whether that investment makes sense. And if you come to the conclusion that it doesn't, then you sell. The second and third reasons why you should sell a stock are kind of related. Finding a better opportunity just means that you find something in the market that you don't currently own that has the promise and the potential of future returns that are better than what you currently own. That could mean that you find a much higher quality company out there. It could also mean that you find a much cheaper company out there, given that the quality could be the same. And so that's why I put an asterisk here next to the overvalued, because when a company is overvalued, the reason why you would want to sell it is to put that money into a fairly priced or a undervalued company, which essentially just means finding a better opportunity. But there are some caveats to number 2 and number 3 in this list. The first being tax implications. Money is like soap, and the more you touch it and fiddle with it, the more it disappears, the less you have. And so whenever you make a sell on a company, you have to pay a few fees, and that has come down over time, thankfully, with all the free brokerages. But even more than that, you have to pay attention to taxes. And taxes can really eat into your returns. So the more you sell due to number 2 or number 3, the more taxes are going to actually impact your returns over time. So if you're going to sell a stock in your portfolio just because you found a better opportunity or it's overvalued and you're going to put it into something that's now fairly priced or undervalued, you better be damn sure that that's the case. Because in all of these scenarios, there's also a good chance that you could be wrong. And that would just be devastating. Imagine selling a high performing company to buy a lower performing company and paying taxes during the process. Now you're just destroying your returns. Some value investors, and especially those that are more traditionally minded, put more of an emphasis on number 2 and number 3 in this list. The whole point of value investing is that you buy a stock when the price is lower than the intrinsic value of the company, and then once the price catches up, then you sell. But this strategy is more resembling to trading because you're always having to find new opportunities, you're always paying taxes, and you always have to be right. What I found over the years studying all the best investors in the world is that the best investors in the world let their winners run. It's normal for very high quality companies to get a premium multiple. The same way when you go out shopping, a high quality product will be more expensive than a lower quality product. When you go shopping for companies, a company that's very high quality, that's very durable, defensible moat, and that has its cash flows growing very quickly over time, is going to be more expensive than a lower quality company. The market is not dumb. So companies that trade for an expensive multiple, it's because the market realizes that this is a high quality company, or at least that's what the market expects. And yeah, the market gets it wrong sometimes, but a lot of the times it's right. If we pull up the best performing stocks over the past 30 years, we can see that all of the ones in this list have probably gone through several long periods of time when their stock looked very overvalued. That means that at first glance, when you're first making the purchase, the free cash flow multiple is very, very elevated. We've got Nvidia on the list, Amazon, Netflix, Apple, ASML, Gilead, Intuitive Surgical, Tesla, Amphenol, Novo Nordisk, Costco, Broadcom, MasterCard, Progressive, Intuit, Microsoft, and the list goes on. I can tell you just from looking at them that a lot of these stocks are trading for very high multiples today. If you had sold any of these stocks in the previous decade just because they looked expensive, you would have missed out on incredible returns. The reason why these stocks are expensive is because the companies that they represent are able to grow revenues and earnings consistently over time. And so if we go back to Broadcom, what's more interesting to me rather than see what the stock price is doing is what's happening to the company's fundamentals. What's happening to the company's revenues and free cash flow? Is the business model getting better over time or is it getting worse over time? By the way, if you want to try out the Rated A platform, it's free for a full 2 weeks and you can cancel at any time. So there's zero risk involved for you. You'll be able to see some deep analysis and research into many different high quality companies like Broadcom. And you'll also see when the price of those companies comes down to a buy range for you to be able to get decent returns in the future. Personally, it's what I use and it's worked really well for me so far. If there's any company that you're curious about and you want to do some research in, let me know in the comments below and I'll add it to the Rated A database. Moving on to Broadcom, we can see that this company is just killing it in terms of revenues. It's growing like a weed, and it's a similar story for the free cash flow per share. Broadcom actually reported earnings last week, and in my opinion, they were really good earnings. Net revenues are up 20% from last year. Cash flow from operations and the free cash flow were both up around 40% compared to last year. If we look at the business split, it's 50-50 between the semiconductor solutions, so semiconductor chips, and infrastructure software, which most of it is coming from the acquisition that Broadcom did last year of VMware. And I like that the infrastructure software is now a bigger percentage of the overall pie because this type of revenue is subscription based, it's very high margin, and it's also way less cyclical than the semiconductors. Semiconductors go through boom and bust cycles, whereas the revenue coming from the infrastructure software is as steady as can be. One of the big reasons why people are excited about Broadcom is its involvement in AI. And the AI portion of Broadcom's business is doing really well. The CEO says, Broadcom achieved record second quarter revenue on continued momentum in AI semiconductor solutions and VMware. Q2 AI revenue grew 46% year over year to over 4.4 billion, driven by robust demand for AI networking. We expect growth in AI semiconductor revenue to accelerate to $5.1 billion in Q3, delivering 10 consecutive quarters of growth as our hyperscale partners continue to invest. So this isn't slowing down. And if we take the numbers for Q3, which are about 5 billion, that's about 1/3 of the revenues of the entire company. So it's starting to be a significant portion of Broadcom's business. And that's a good thing because AI is only growing from here. Broadcom's role in AI is that they make ASIC chips. What's an ASIC chip? It's a custom chip that's designed to do one very particular task extremely well. For example, NVIDIA's chips are much more general, much more broad, so you can use them to do a whole bunch of different activities. Broadcom makes chips that are very specifically targeted to do one task. And what that means is that Broadcom is working with some AI companies that you would recognize, like Amazon, Meta, Google, OpenAI, Apple, and TikTok, in order to make specific chips for those specific companies' workflows. Because, yeah, these companies right now are paying tons of money for NVIDIA chips and they want to become less reliant on NVIDIA. And so Broadcom is stepping in and doing them all a favor. That's the reason why Broadcom's AI revenues are growing at 40% year over year. Is this type of revenue growth going to continue? I don't know. Nobody knows. It could even accelerate from here. I think that the growth is going to continue for at least a few years. It might go down from 40% to 30 to 20, but this will be a secular tailwind for Broadcom for years to come. So that answers the question whether I'm going to sell or keep my Broadcom shares. I'm going to keep them. Even though Rated A is showing that the value rating is 0 and I should absolutely sell this stock, I'm going to keep them. It might turn out to be a mistake when I look back 2 years from now. But what I'm trying to do is not pay attention to the stock price and pay attention to the fundamentals. And as long as the fundamentals are going in the right direction, as long as Broadcom is rated as an A quality rating, I will most likely keep those shares in my portfolio. That's it for this video. Have a great day and I'll see you in the next video.